Good afternoon. This is Tom Aspray for the Viper Report on Friday afternoon, October 19th. Well, stocks had a choppy session on Friday, which finished a choppy week. You can see the Dow closed up 64 points. It was up 244 intraday as the stock market opened very strong and then drifted lower for the rest of the session. The S&P 500 was up over 23 points early on. You can see the intraday chart here to the right, and then spent the rest of the day declining, closing down 1 point on the session. Market internals, that's the advanced decline line, which is a key indicator in my view to timing both the short, intermediate, and long-term swings, closed negative, 1,454 up, 1,521 down. They were better than 2-to-1 positive around 11 a.m. Eastern Time. Number of new lows, as we discussed a few weeks ago, the rising new lows was one of the warnings of the stock market as we started the month of October. Last week's sharp intraday move was pretty much expected as we started the week. Over a week ago, I was looking for a 50 to 100 point rally in the S&P 500. We got it. This chart is of the triple Qs, the technology sector, which was beaten down hard a week ago, getting down to 167. It rallied up to 177 on Wednesday, but couldn't hold on to those gains, drifting lower and closing down 0.75% for the week. Looking at the sectors, consumer staples were the leader last week, up 4.4%. Procter & Gamble had some blockbuster earnings. It was up $7. That fueled much of the gain. Real estate was also higher, as were utilities, all defensive sectors. Some of the big banks helped the financial stocks manage a gain, but based on my work, it's still a sector that is in a sideways to downward trend. The year's leading groups, that is technology and consumer discretionary, were both down in the session. Consumer discretionary was down 2%, one of the biggest losers, as was energy. My work on crude oil started the week suggesting that energy prices would decline. We exited out of our energy stocks on Monday and avoided this downdraft. Though the AD lines have not been updated yet, there's no change in our near-term outlook. That is that this correction is not over yet, and it has further to go. This is a chart of the Nyc Composite. You can see the AD line did diverge at the September 21st highs, still below its declining moving average and its downtrend. Below this, we have the stocks only AD line, shows a similar pattern, has not bottomed yet. If we retest the recent lows, which is likely sometime this coming week, we'll be watching the action closely for signs of an upside reversal. We have a number of ETFs, several in our favored healthcare sector, they are looking to buy once we see signs that the selling is over. As most of you are aware, I also write the Viper ETF and the Viper Hot Stocks Report. Both are sent out twice a week and include extensive market commentary as well as specific buy and sell advice. If you're interested in trying one of them out, you can go to viperreport.com. For the Viper ETF report, you can see the Viper ETF on the masthead. If you click on that, it'll tell you about the service and what we provide. And you can sign up through PayPal. That allows you to control your subscription. If you're more interested in individual stocks, then the Viper Hot Stocks Report includes a weekly scan of stocks with new buy and sell signals, from which I select those to make long or short recommendations. A subscription to each service includes 6 of my trading lessons that'll explain some of the major techniques that I use and help you understand the analysis. I also do some one-on-one mentoring and training for those of you who might be interested In particular, I'm doing a series of courses on understanding and using the advanced decline line. There are only a limited number of spots available for the last sessions before the end of the year. If you're interested in this or any other services, of course, you can always email me at tom@viperreport.com. I'll plan on sending another update out sometime next week. Hope you have a great weekend. Thank you.